Are you curious about the latest surge in commercial real estate deals? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In the first quarter of 2025, commercial real estate acquisition volume has risen by an impressive 17%. This surge indicates a robust start to the year for the sector. However, there are looming trade tensions that raise questions about whether this momentum will continue into the second and third quarters. The source of this information is Ashley Fahey, managing editor of national content at the Business Journals. The increase in acquisition volume reflects growing investor confidence and interest in commercial real estate across various segments, including multifamily properties, tenant leasing, and industrial developments. In Kitchener, Waterloo, London, and Cambridge, Ontario, similar trends are observed with local investments showing a positive uptick. This mirrors the American landscape, where cross-border relevance is evident as investors in the United States also show heightened activity in these areas. Despite the positive start, the report highlights concerns regarding trade policies that could impact office leasing momentum. Tariffs are casting a shadow similar to the economic impact seen during the COVID-19 pandemic. For instance, office developments and tenant leasing might face challenges if trade tensions escalate further. Industrial real estate, on the other hand, is anticipated to brace for potential impacts as tariffs cloud the landscape. This sector has been a popular investment choice, and any shifts in trade policies could influence future developments. Investors and stakeholders are closely watching these developments to gauge their potential effects on the market. In Lake County, recent land acquisitions by developers from New York and South Florida are signaling the start of significant commercial development. The purchases in Lady Lake and Fruitland Park have sparked interest in what could be ambitious projects aimed at transforming the area. This news comes from Trevor Fraser, a staff writer at the Orlando Business Journal. These strategic land buys are drawing attention due to their potential to ignite a wave of new commercial ventures. Observers are keenly watching how these developments might align with the ongoing growth trends in the region, which has seen a mix of residential and commercial expansion. While the Orlando area continues to experience a real estate boom, these land purchases in Lake County suggest that developers are looking to capitalize on the expanding suburban markets. This aligns with broader trends seen in areas like Kitchener, Waterloo, London, and Cambridge, Ontario, where similar investments are reshaping the local landscapes and attracting attention from both Canadian and American investors. In the United States, the interest in expanding into suburban and less densely populated areas mirrors the activity in Ontario, with investors recognizing the potential for growth outside the traditional urban centers. This cross-border relevance highlights a shared confidence in the strength of suburban markets as viable options for future commercial development. In a notable transaction, a real estate firm based in Brentwood has acquired a 19-story office tower located at 525 North Tryon Street in Uptown Charlotte. The purchase price was $24 million, which represents a significant discount from the tower's previous sale. This acquisition underscores the current dynamics in the office market, where fluctuations in pricing are creating both challenges and opportunities for investors. Such transactions are indicative of the broader trends we're observing in the office real estate sector. Office properties, particularly in urban centers, have faced various pressures, including remote work trends and economic uncertainties. This has led to decreased demand in some areas, resulting in price adjustments that savvy investors are keen to capitalize on. In Ontario, particularly in cities like Kitchener, Waterloo, London, and Cambridge, we are seeing a somewhat different picture. Here, the office market has shown resilience, with stable leasing activities and sustained interest from businesses looking to establish or expand their presence. The differences between the Canadian and American office markets highlight the nuanced landscape that investors must navigate. From an American perspective, the Charlotte office tower acquisition by the Brentwood firm reflects a strategic move to leverage the current market conditions. While some office spaces are struggling, others present unique opportunities for long-term growth. This cross-border relevance is essential for understanding how investors are approaching the office market in different regions. In a significant development within the multifamily sector, several apartment complexes located in Tampa and St. Petersburg are part of a major foreclosure process, amounting to $400 million. The foreclosure highlights the financial strains faced by over-leveraged property owners in the region. This information comes from Ashley Gerbel-Kritzer of the Tampa Bay Business Journal. The situation serves as a cautionary tale for investors in the multifamily market, where aggressive leveraging can lead to substantial risks, especially in volatile economic conditions. The Tampa Bay area, known for its vibrant real estate market, is now witnessing the repercussions of such financial strategies. Interestingly, similar trends are observed in the Kitchener, Waterloo, London, and Cambridge areas of Ontario. Here, the multifamily sector has shown resilience, with developers and investors maintaining a more cautious approach to leveraging. This contrast highlights the importance of strategic financial planning in real estate investments across different regions. From an American perspective, the Tampa Bay foreclosure situation underscores the challenges faced by property owners who may have overextended themselves financially. It also serves as a reminder of the potential pitfalls in the multifamily sector, where market conditions can swiftly change, impacting the financial viability of heavily leveraged properties. In a recent discussion on CNBC's Squawk on the Street, Jonathan Gray, President and Chief Operating Officer of Blackstone, shared his insights into the commercial real estate landscape, particularly focusing on the demand for artificial intelligence data centers. Gray expressed a strong belief in the continued demand for data centers, despite some challenges posed by recent chip export restrictions and tariffs. According to Gray, the trend towards increased data center usage is powerful and expected to persist. He highlighted that while export restrictions are creating some slowdowns, the demand for United States-controlled data centers remains robust as they address security concerns. Gray noted that the artificial intelligence sector is still in its early stages, yet significant growth is anticipated year by year. The recent rebound of big tech stocks, as seen with the Roundhill Magnificent 7 ETF climbing above its early April closing price, underscores the renewed confidence in the artificial intelligence trade. Reports from Meta Platforms and Microsoft have contributed to this optimism, dispelling fears of a United States economic downturn and uncertainties surrounding global trade barriers. Gray also emphasized the importance of addressing electricity demands for the growing data center infrastructure. He believes that while constraints exist globally, investments in renewable energy and natural gas will be essential to meet the energy needs of this technological revolution. Furthermore, Gray remains optimistic about the broader commercial real estate market, suggesting that the recent reduction in new developments over the past few years is setting the stage for a significant recovery. This optimism extends even to the office sector, which has faced substantial challenges since the COVID-19 pandemic. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.